Bitcoin and the Great Secret Reset. In less than 3 days, over $1 trillion vanished from the cryptocurrency market. Bitcoin plunged from levels close to all-time highs to values that erased billions in leveraged positions. Ethereum followed the same trajectory. Altcoins collapsed one after another. And the entire financial press repeats that this is only a correction, a normal cycle, the market simply being the market. Enjoying the content? Don't forget to hit subscribe and smash that like button. But what if I told you this is not a random crash at all? What if I revealed that this is the first step of something much more calculated? A plan prepared for months, carried out by actors most people don't even know exist, and designed to reshape the entire cryptocurrency landscape before the next bullish phase even begins. Stay with me because what I'm about to show you will radically change the way you understand what is happening to digital assets right now. The official narrative. Headlines speak of a crypto winter. Analysts attribute the fall to traders too exposed and to profit-taking after the rally. Regulators point the finger at instability and claim this proves the need for greater supervision. Retail investors, frightened, sell at a loss, convinced they missed the top and must cut losses before it gets worse. Yet none of this truly explains what triggered the move. No one clarifies why the selling started exactly at that moment, why certain wallets moved huge amounts of Bitcoin hours before the drop, or why large institutional operators quietly accumulated throughout the decline. This is not disorder, it is choreography, and those directing it have already done it before. The precedents. March 2020, Bitcoin falls to 3,800. May 2021, China bans mining. November 2022, FTX collapses. Each time the pattern is identical: massive coordinated selling, panic among small investors, and silent accumulation by institutions that provoked the crash. This time, however, there is a substantial difference. It is not only about shaking out weak hands. It is a strategic repositioning for a structural change, how cryptocurrencies will be regulated, traded, and controlled at the institutional level. An unusual collapse. The downturn began on Sunday evening. Already unusual. Major market moves rarely occur on weekends when liquidity is scarce and institutional desks are closed. Yet that's exactly when it started. Bitcoin lost 8% in less than 2 hours. No relevant news, no evident catalyst, only sudden aggressive selling. Within 12 hours, the entire market followed. Ethereum, 11%, Solana, 15%, smaller altcoins, 20, 30, even 40%. Liquidation swept across every major exchange. Over $2 billion in leveraged positions erased in a single day. And behind the scenes, on-chain data showed the opposite picture. Large wallets, those of institutions and ultra-wealthy individuals, were not selling. They were buying, quietly, methodically, at the prices where retail investors were desperate to exit. This dynamic has a name: liquidity grab. One of the oldest techniques of traditional finance, now executed perfectly in crypto markets. Why right now? To understand, you need to look at what has happened in the past 6 months in institutional infrastructure. November. The Singapore Exchange announces perpetual futures on Bitcoin and Ether. A huge signal. Singapore does not approve such products without institutional demand and regulatory clarity. At the same time, several sovereign wealth funds and pension funds were reported in the final stages of approval for direct Bitcoin allocations. Not via ETFs, but direct custody. Just weeks before the crash, the Financial Times reported that various central banks were studying frameworks to hold digital assets as part of reserves. Not stablecoins, not CBDCs, but Bitcoin and Ethereum. In short, institutions were preparing to buy. Regulatory clarity was improving. Infrastructure for massive capital inflows was ready, and precisely then the market collapsed. Coincidence? or the perfect setup to accumulate at depressed prices before the real move begins. Institutional logic. Institutions do not buy at all-time highs. They do not chase price. They create the conditions for price to come to them. In a relatively small market like crypto, the simplest way is to provoke a cascade of liquidations that forces small investors to sell at a loss. If you manage a sovereign wealth fund with a mandate to acquire 10 billion in Bitcoin, you don't buy at market and push the price against yourself. You wait for a crash. Better yet, you provoke one. You coordinate aggressive selling during low liquidity windows. You trigger stop losses and margin calls. You let fear do the rest. Then you accumulate slowly, while everyone else believes the market is dead. This is not conspiracy, it is strategy, and the data shows it is exactly what happened. The regulatory layer. There is another dimension. While the market was collapsing, regulators advanced. In the chaos of a crash, when everyone is focused on price and losses, policy moves forward without opposition. Days after the downturn began, several jurisdictions advanced frameworks for stablecoin regulation. Frameworks that distinguish compliant institutional-grade stablecoins from offshore, unregulated alternatives. Random timing? No, deliberate timing. What is being built is a two-tier system. Institutional tier, regulated, compliant, with access to banks, custody, and legal clarity. Retail tier, offshore exchanges, unregulated stablecoins, constant uncertainty. The crash is the transition point, the moment when the Wild West era of crypto ends and the institutional era begins. Signals of accumulation. Right now, Bitcoin trades well below where it was 3 weeks ago. Retail sentiment is gloomy. Fear and uncertainty dominate forums and social media. But institutional order depth on major exchanges is increasing, not decreasing. Large buy orders sit below current prices, ready to absorb further selling. That is not bearish behavior. It is accumulation. At the same time, U.S. Bitcoin ETFs continue to record net positive inflows, even during the crash. Professional investors see an entry opportunity, not an exit signal. And in OTC markets, less transparent, activity is at record highs. That is where institutions buy large amounts without moving prices, invisible to most, but evident weeks later when supply tightens and price rises without obvious cause. The real stakes. This is not just about Bitcoin. It is the entire architecture of digital finance being restructured in real time. The key is stablecoin regulation. Once governments set clear rules on which stablecoins are legal and which are not, they effectively control the on and off ramps of the entire crypto ecosystem. You will not be able to move money between exchanges, wallets, and banks unless you use approved stablecoins issued by regulated entities. It seems restrictive, and it is, but it is also the clarity institutions require to deploy massive capital. They will not enter a market where fundamental infrastructure could be shut down by regulatory action at any moment. But once that risk is removed through clear legal frameworks, the floodgates open, and that is what this crash is really preparing for.